Hi, all. We are back with our next chapter, chapter 2, where we're going to talk about job order costing. Um, I am just going to jump in once I share my screen. Okay, so this is a cost system. We have learned all our vocabulary in the last chapter, and now we're going to put it to use. Okay, so the first system we're going to look at is job order costing. This is when you have a lot of different products that are produced each period. Those products are made to order, and each order is unique. So you'll be able to trace your costs to that particular job, okay? And you can maintain your records accordingly. All right. So some examples of this would be like construction, manufacturing on large items like yachts or airplanes. And then something that we might have all actually used, Vistaprint, that is a company that makes business cards because each batch is unique with your information on it. Um, it is made to order. Okay. So we are going to be able to trace our direct materials to each job. Same thing with direct labor. Then our manufacturing overhead, we are going to spread it over all the jobs, and we call that spreading allocation. Okay, so this is an example of what a job costing sheet would look like at one of these companies. Um, you can see they have the job number, the date, when you initiate it, when you completed it, how many units, um, what the item is that they're buying. Then you're going to have your direct labor, or I'm sorry, direct materials, direct labor, and then your manufacturing overhead. Okay, so first things first, we have our requisition form. Um, this tells you that you have a job, you need these items, okay, and the finished product is going to cost $116 as far as materials are concerned. Okay, so in your direct materials column, you have your requisition number. Okay, and then you have the amount in direct materials that it took to create that particular order. Next up, you have a timesheet. This is where your direct labor is going to come from. Okay, so you have in an 8-hour period an hourly rate of $15 an hour. Okay, that's going to be $120 in direct labor for this item. So again, direct labor, timesheet 36, we had 8 hours, $120 total. So all of that, trickles down into this cost summary. Last, we're going to spread out our overhead. Okay, this is the only part that's slightly complex. So when first we have to choose an allocation base. All right. Remember when we talked in chapter 1 about cost drivers, okay, what it is that's driving this cost, okay? You want to use an allocation base because it's difficult to tell which job this belongs to, okay? There can be a whole bunch of things lumped together in this manufacturing overhead, and we have to decide how we're going to spread it out over our allocation base. All right. So we create a predetermined overhead rate to apply overhead to the jobs. All right. So before we actually perform the work, we're going to decide how we spread our overhead. Okay. Remember, on the last slide, I started talking about cost drivers. Your allocation base should be that cost driver so that these things are actually related. All right. So you want to take your total manufacturing overhead cost and you want to divide it by your total units in the allocation base for the upcoming period. These are both going to be estimated, right? Because we're estimating for the period that's coming up. It hasn't happened yet. Okay. This is just repeating what I said. We don't have the actuals yet. Okay. So we need to use these estimates. All right. So we're going to go through this stepwise process. It's a 4-step process. Step 1, estimate the total amount of the allocation base. That's the one that goes on the bottom, the cost driver. Okay. Estimate the total fixed manufacturing overhead for the upcoming period. How do you do that? Well, you base it on prior data, right? And if you're a startup company, you will base it on some other company's data that is similar to your company. Okay. After we have these two estimates, we're going to use the following equation to estimate the total amount of manufacturing overhead. Okay. So we've got our fixed manufacturing overhead estimated up here, but we need the total amount. And we're going to use our y equals a plus bx formula. Then we compute the predetermined overhead rate. Don't worry, we're going to work an example. Okay, so in this example, the pear company estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. In addition, the company estimates that the total fixed manufacturing overhead is 200,000 and the variable portion is $2.75 per direct labor hour. So already we know we're going to use our direct labor hours as our allocation base. All right. So first we calculate what our total overhead is going to be. All right. We know the fixed part is 200,000. Okay. Fixed manufacturing overhead at 200,000. Okay. Our variable is 275 times our 160,000 direct labor hours. Okay. So that's going to give us a total manufacturing overhead of $640,000. Okay. Divided by our $160,000 direct labor hours, that gives us $4 per direct labor hour. That is how much overhead we are allocating. All right. So we know that we used 8 hours of direct labor. Okay. So we are just going to slap that over here. Then our rate is $4 per hour. That'll give us $32. Okay. All right. So the total cost the cost to us for this job, right? We have $116 in direct materials, $120 in direct labor, $32 of overhead. So this total project is going to cost us $268. All right. So, but we are actually making 2 units. So our per unit cost is $134. We just divided this by 2. Okay. In the interest of time, I'm going to skip over the concept checks. Please feel free to review the slides and go over the concept checks. The answers are provided in them. Okay. I touched on this briefly, but please be careful about choosing your allocation base, because if you choose a method of allocating your costs that isn't really related to that cost, um, it can backfire on you. Okay. Um, your job order costing, all right, it is able to accurately trace your direct materials and your direct labor. Okay. But human error creeps in when it comes to allocating overhead, because a lot of times people choose a base arbitrarily and it doesn't give them good data. Okay. Um, so a lot of times companies will use one predetermined overhead rate for all manufacturing overhead costs, no matter what they are. Okay. This is a super simple way, and in very simple businesses, it might be effective enough to get the job done. Okay. Um, but if you have a large operation, this is going to be way oversimplifying your model. Okay. Um, if you're able to identify more than one overhead cost driver, it is possible to improve your model by using multiple predetermined overhead rates. Okay. Um, and we'll see an example of that. So Dixon Company has two production departments. They have the milling department and the assembly department. Okay. The company uses job order costing and computes a predetermined overhead rate in each production department. So there's two predetermined overhead rates. Okay. The milling department is based on machine hours, and the assembly department is based on direct labor hours. The company uses cost plus pricing at a markup percentage of 75% of the total manufacturing cost. That just means that we determine what the cost is to us, and then we mark it up by 75% to make a profit. Okay. That's how we establish our selling prices. At the beginning of the year, the company made the following estimates. So, machine hours, 60,000 for milling, 3,000 for assembly. You can see a lot of machine hours go into that. That's probably why they're using that as their allocation base in this department. Direct labor hours, only 8,000 in the milling department, 80,000 in assembly. Okay, this is your allocation base for assembly. Total fixed manufacturing overhead cost, 390,000 for milling, 500,000 for assembly. Variable manufacturing overhead per machine hour. Remember, in the milling department, that's our allocation base, $2 per machine hour. And then for the assembly department, we're using direct labor hours, so it's going to be 375. Okay. Now, let's calculate the predetermined overhead cost for each department. All right. So for the current month, the company and completed job 407. It wants to use the predetermined departmental overhead cost and rate for milling and assembly. All right, so the milling department, 390,000 in fixed costs, and then we allocate $2 per machine hour times 60,000 machine hours. That's going to be 510,000 for the year. Assembly department, the fixed portion is 500,000. We're going to allocate $375 or 375 $3.75. Reading is fundamental per direct labor hour, and times 80,000 direct labor hours. That's going to give us 800,000. Okay. Let's calculate the predetermined overhead rate for each department. All right. So our milling department, 510,000 divided by 60,000 machine hours, $8.50 per machine hour. Assembly department, 800,000 divided by 80,000 gives us $10 per direct labor hour. Okay, so we're using our predetermined overhead rate to calculate um, that which we calculated on the previous slide to determine the overhead applied for both departments. Okay. So we have this information that we received in a previous slide. The milling department, 90 machine hours on job 407 at $8.50 per machine hour gives us $765. Assembly department, they use 20 direct labor hours on this job at $10 per direct labor hour gives us $200. Okay, then we calculate the total amount of the cost for job 407. We have our direct materials, our direct labor, our manufacturing overhead applied. That's using both milling and assembly. Okay, so the total job cost was $2,485, but we're not done because we have to mark it up by 75% so we can make a profit. Okay, so 75% of 2,485 is 1,863. We add those together and we have the selling price for that item. Okay. If we had not used this departmental approach where we came up with the two different overhead rates, we would have gotten very different numbers here, and it would have adversely affected our decision making. Okay. When you do this, when you create your overhead rates based on the activities that they perform, it's referred to as activity-based costing. All right. This is an alternative to developing multiple predetermined overhead rates like we did in the last example. All right. Managers use this ABC system to accurately measure the demands that jobs, products, customers make on the overhead resources. Okay. So the amount of overhead that you apply during a period is going to differ from the actual amount of the overhead cost. So remember, with this job order costing, how we came up with these estimates. All right. So we're not perfect. We are not going to make a perfect estimate. So at the end of the year, we need to assess, compare it to our external financial statements and see how our estimates compare. Okay. If you apply less overhead to production than what actually occurred, then you're going to have underapplied overhead. And when you apply more overhead, than what actually happened, you're going to have applied overhead. So if you have underapplied your overhead, okay, that's going to increase the cost of goods sold and decrease your net operating income. I'm sorry, let's back up. If you when you make the adjustment for underapplied. So you have underapplied the overhead, which means that you have reported under the amount of costs you had. Okay, so in order to fix that, you're going to have to increase your cost of goods sold and decrease your net income. All right. So if you over applied your overhead. Okay. To fix that, you're going to have to decrease the cost of goods sold and increase your net operating income. All right. So we learned about this in financial accounting, but just be aware that if you are using this system, job order costing, each one of these job costs are going to go into, or each one of these cost sheets rather, are going to go into a subsidiary expense ledger, okay, which will roll up into your works in process and then your finished goods. Okay, so this, you may not actually have a card that you fill out. This is sort of happening in the background in your accounting software. But each one of these jobs is going to go into your works in process and your finished goods. Okay. And then once you have sold these items, they will go into your cost of goods sold. Okay. Um, Service companies also use job order costing. Okay. Law firms, accounting firms, and some doctors' offices have this concept of billable hours. Okay. You bill hours to a particular client, that's job order costing. Okay. That client's services packaged together are their order, but they're ordering services instead of products. That is the end of chapter 2.